Okay, I'll just test so you guys can hear all right. Is the sound okay for you guys over there? You good? Got a nod? Good, good. What about you people up the back? You okay? Okay, and you guys okay down here for sound? And you guys in the middle are okay, I guess? Good. Right, okay, so what I'll do is basically just go over some of the main points we covered last time, and then we'll progress on. So this is the overview of the course. So basically we're looking at almost the entire financial system in a couple of lectures. And we start off by saying that there are 5 purposes for the financial system. The first one up is it's there to facilitate the flow of funds. So there's this basic problem that some people have surplus to their needs. They wish to invest, they wish to save, they wish to gain a return. And then there's those which are currently in deficit and they need to borrow money. And so the financial system exists in many ways to serve that particular purpose, getting money from where it is surplus to where it's needed for people in deficit. There are 4 more functions, and in some ways each of these functions serves in one way or another the first one. So that of the 4 remaining ones, obviously, you have to have a way of settling these transactions. So if money is going to move from someone in surplus to deficit, you need a way of moving it, and that is dealt with by what we call the payment system. And there's quite a number of components to this payment system, but it's there to move money from one party to another. Third thing, we talked about this yesterday, is there to generate information and to also disseminate that information out to those who require it. And when we looked at an example yesterday at the New Zealand stock market, it actually has on its website announcements that come in from companies. It's put online, so it's immediately available. So we want our financial system to make that available freely to people who require it, because as investors and as borrowers, they need to make informed decisions about where they invest their money. And often, if you're going to borrow in some way, there are a range of options open to you, and you need to pick the best one amongst them. The third thing, well, it's actually the 4th thing on the list, is that we want the financial system to deal with risks that we face. And there's sort of essentially 2 categories of risk. There's financial risks. There's actually risks associated with particular securities, particular financial transactions. And sometimes these risks that we face are ones that they're too great for us to face alone. And so we would like the financial markets in some way to provide a mechanism for us to deal with those sorts of risks. And there's another set of risks that we call the pure risks. For an example of that, if you own a house, there's a chance that your house may be damaged by fire. And then there's an entire section of the financial system, the insurance sector, which deals with that type of risk. And then the final one we talked about was the problem of dealing with misaligned incentives. And the example we talked about was the principal agent problem. Example would be that in a publicly listed company, the people who own the shares are the owner of the companies. What's good for them is they would like high profits from that company, gives them a high return. But the agents are the managers and employees of that company, and for them, high wages and salaries and high bonuses is what's good for them. And so the incentives for the people who run the companies are different from those of the owners. And so we want our financial system to provide us with ways of dealing with that type of problem. Then we moved on to talk about 3 types of efficiencies, and this is essentially a wish list of what we would like our financial systems or our financial markets to be. The first one up is what we said we'd like it to be allocationally efficient. If you think that there is only a finite amount of capital available for investment, and there's a broad range of people out there, individuals, corporations, and government, which would like to use it, what we want is a mechanism to allocate the capital to those uses which are going to give us the highest return. And by best return or highest return, we're typically talking purely financial in that case. The second thing we want our markets to be is informationally efficient. And what that means is that when we go and look at the market and we look at the price in the market or an interest rate in the market, we want all available information about that particular security to be correctly incorporated into the price. And the reason we want that is, if we're thinking about the purpose of allocationally efficient, if the price is right, then that gives us a clear signal about what the value is, and hopefully price will equal value, and that will guide us about how we do our allocation. The final thing we talked about was being operationally efficient, so we want the markets to run smoothly, quickly, and with a minimal amount of transaction costs. Because if, again, you're thinking about the capital, we don't want the capital that's supposed to go out to investment to be siphoned off in transaction costs. Of course, there's a conflict there because the people who work in the financial sector, that's how they get paid. And so they'd like to take as much as they can get hold of. And then we moved on to talk about direct and indirect financing. In direct financing, basically, there's no middleman between the investor and the end user of the funds. And a couple of examples would be, say, a company issued a bond, then an investor bought that bond, then the money goes from the investor to the company, and there's no middleman sitting in the middle of there. Similar with common stock. If the company issued common stock, someone would buy that stock, and there'd be no middleman sitting in the middle, which is different from indirect finance when there is a middleman sitting in the middle. Then we talked about brokers and dealers. These are critical to the functioning of the financial markets. Brokers essentially are people who go out and match orders. So if you want to say you have shares in a company and wish to sell them, you typically would ask a broker, could you sell my shares for me? And they would find a buyer. And for that, they would earn a fee for service, which we typically call a commission. Now, a dealer is someone who actually owns and deals in the securities that is being traded. So if you want to buy or sell in a dealer market, you actually buy from a dealer, or if you're selling, you sell to a dealer. And for example, maybe some of you have already met this already, if you want to do some transaction between foreign exchange, either bringing foreign currency to New Zealand, getting New Zealand dollars, or selling New Zealand dollars and getting some foreign exchange, typically you will deal with a bank, and the bank in that role acts as a dealer. They either sell you the foreign currency and buy yours, or the other way around, as the case may be. But you're dealing directly with the person who is going to buy and sell, and not through the broker. And the dealers, they essentially set two prices, one that they will sell at, and one that they will buy at. And the difference between those prices is how they make their money. They basically make their money on a per trade basis. And that brings us to this point here. This is related to the indirect finance. We're at this point talking about financial intermediation. So what is meant by the term financial intermediation? And we're going to ask another question about what problems with direct financing does financial intermediation solve? So what do we mean when we're talking about financial intermediation? What are we actually talking about? What is happening in financial intermediation? The middleman. Oh. Transforming from something to something else. Okay. So far, so good. Okay. Can you go further?
Like, maybe if we're talking about, like, people not having, like $1 million denominations or something, so they need to take lots of different pools of money to transform it into something that they can actually sell.
Okay, that's quite a good example. In some markets, particularly like, say, the money markets, the minimum trade size and typically is $1 million, even larger. Sometimes they're very large. And for a private individual, most people just don't have $1 million to go and invest in something like that. But there's often cases where you actually would like to invest in that type of market. And so because you as an individual don't have $1 million, but you would like to invest in that market, what you need is some middleman which will basically, in this case, take a whole bunch of little bits, put it together, and go and invest that market. So in the money market, if there's, say, commercial paper going, and there are $1 million lots, and you only have $1,000 to spend on it, banks, brokers, other financial institutions will provide things often called a cash management account. You can deposit your money in there, and they'll put your money with other people's money, and then they will go and invest in this market. So that means that you can have access to markets that you would not otherwise have access to, but it's quite clear that there is a financial institution sitting in the middle that handles this space of taking small amounts of money, putting them together, and then investing them in another market. And for that, of course, they'll earn some sort of commission along the way. They'll make their money out. So how is financial intermediation related to indirect claims? Yeah, go ahead.
Because basically the financial intermediary will take the SSU's funds and then give them a financial claim for the financial intermediary, and then it takes those funds and then gives it to like a DSU, so a company or somebody who wants basically that capital, and then they'll get a financial claim from DSU. And so basically, although that's an indirect claim because the original suppliers of the funds are not actually they don't have a direct claim on the financial assets of the DSU. They have a financial claim on the financial intermediary.
Excellent. I should have given you a microphone. That was really good. That was really good. Okay, so probably most of you didn't hear what he said, so I'll have to summarize. That's okay. No, it's good. I'll probably cut it down a bit. Essentially what's happening is that if you think of the financial intermediary in the middle, there's two sets of financial claims. There's one between the financial intermediary and, say, an end borrower. For example, if we're going to talk about a bank as a financial intermediary, it may be making, say, a loan to a household for a mortgage, and there's a direct claim there. There's a direct claim between the bank and the mortgage holder. On the other side, between you, say you put in a term deposit, there's a direct claim between you and the bank. So there's two direct claims, but indirectly you have, if you think about what is backing up your investment, well, what's backing up your investment in the bank in terms of a term deposit is the mortgages and other loans it has over here on its own books. And when you think how a bank is structured, and we'll come to this in the section on commercial banks, typically around 92-93% of all funds that the bank has to go about its business are borrowed in one form or another. Only sort of around 7-8% is actually equity supplied by the owners of the bank. And so they make an entire business out of taking money from people. They have all these on this side, all the depositors and all the people. They're all direct claims. They take that money and they make a bunch of direct claims where they actually holding things as assets on the other side. And so there is an indirect link between what you put in and what they have there on the other side. And they sit in the middle and they manage all that, and for that they earn their profits. So let's see, did we miss anything? Probably not. Talked about big denominations. Talk a bit about this. Like these things, when you look at them, this one here, set here, is probably you related to a bank. If you're dealing with a financial intermediary, one of the key things we have to do in the finance system is assess the level of risk that is there and price that risk correctly. If you think about a bank term deposit, the risks are quite different to the risks that you take in your KiwiSaver account. And of course, what you have to do as investors is assess that risk and price it correctly when you're making this thing. So that's how they got, this sort of group here is where the money comes in. So dollars comes into the financial intermediary, and this is where it goes out on the other side. And they sit in the middle, manage all this stuff, and that's how they earn their money. Okay, so here's a list of 5 services that they provide. This is 5 services. Not every single financial intermediary provides all 5, but this is what you would see: denomination divisibility, currency transformation, maturity flexibility, credit risk diversification, liquidity. Okay, I'm going to ask the question, what are these things? So we'll go down one by one, and why are they important? Let's take the top one. What's denomination divisibility? What is it? Why is it important?
Splitting a large denomination into lots of small denominations. So it's important because, like we were talking about before, not normal people don't have $1 million to go invest in something.
Okay, so that's exactly what we're talking about. We're talking about taking a large denomination like these $1 million lumps in the money market and splitting up a bunch of pieces. And it allows you to have access to markets that you cannot access on your own, unless, of course, you're very, very rich. So denomination divisibility is quite important. Like for example, if you want to own part of Westfield Mall down there, you think this is think it's good business, and you want to own part of it, you don't have to buy the whole mall. You can actually buy a piece, and so an intermediary will actually take that, split it into a bunch of pieces, so that you can actually have an investment in Riccarton Mall if you want to. What about currency transformation? What's that? Why would we want that to happen?
Currency exchange.
Okay, it's currency exchange, and why would that be important to you?
For international companies, like especially like if you doing business in one region and the other region they have different currency exchange rate.
Okay, so if you're a business and you're working across two countries that have different currencies, you need to basically pay all the people in their local currency, and of course you'll probably be paid in your local currency. But if your headquarters is in another country, you want to bring your profits back, and so you've got to change from whatever that currency is to your local one. And this is, it can, it can be something that you yourself might be interested in. Like, for example, if you want an electronic copy of your textbook, the supplier is Australian. They would like to be paid in Australian dollars, but you would probably want to pay in New Zealand dollars, and so you use your credit card. And an intermediary somewhere along the line will take your New Zealand dollars and transfer them into Australian dollars to make the payment for you. And so that's just one of the functions that they take. What about maturity flexibility? What's that one? Go ahead.
Different people will want their money invested for a different amount of time, but you might not, if you're investing by yourself, you might not be able to find something that will have that maturity date. So you put your money with the intermediary, and then they invest it somewhere, and they can give you your money back when you want it, and they can use other people's money to fill the gap and while they wait for the maturity of whatever they invested.
Okay, so one of the key points there, if I summarize you correctly, is that people have different lengths of time they want to invest for. And if you're going into, say, the direct markets, sometimes you simply cannot find something that matches what you want. And what a financial intermediary can do is allow you to invest in that particular type of market. Let's say, for example, you want to invest in bonds, and say there's a fund manager which provides a bond fund. Now, if you look at what they actually hold in their fund, they may have 5-year bonds, they may have 25-year bonds, they may have 30-year bonds in there. If you bought them themselves, you're stuck with them for a long time. But say you only want to invest for, say, 3 years, you can put your money in there, and they will go and in turn invest in much longer dated securities. And when you want your money out, obviously they can't get it back from the companies that issued the bonds, but they can replace your money with new deposits. So if new deposits come in, they can replace your money and they can give you money back. And so when you have like very long dated securities, it's particularly important in the case of common stock, because common stock has no maturity date. If you, say, buy common stock when it's brought to market on a float, it has no maturity date. It's unlike a loan. You will never be repaid, okay, in its common stock. But nobody lives forever, and mostly you don't want to hold it forever until you die either. And so you need some mechanisms of being able to cash out of your investment. And often in some types of markets, bond markets and so on, the financial intermediaries will allow you to invest in either long-dated securities for a shorter period of time, or the other thing they can do, this is what one of the things your KiwiSaver is doing, is it takes a bunch of short-term securities over time and transforms it into a long-term investment. For example, if you started your KiwiSaver when you were a teenager, you can't get that money out till you're 65. So let's say you started when you're 15, that's 50 years. In between, when you put your money in at the start and put money all the way through, is they've taken a whole bunch of comparatively short-term investments and transformed it into a 50-year investment for you. So it works both ways, taking large, long-term investments, breaking down to little pieces, if you need that. Something like KiwiSaver does the other thing. Takes lots of short-term ones, builds them up into a very long one. Both of them are maturity flexibility. What about credit risk diversification? What's that? Go ahead.
Basically, what it means is, especially for somebody who has limited funds and might not actually have the funds to buy in different types of securities and different kind of similar to the denomination divisibility a little bit, where suddenly you've got a large pool of funds, and so you can invest in a whole lot of different types of investments, so in real estate, in your securities, and cash, and bonds. Basically, so that all of the non-systematic risk gets as low as possible, and so that takes the risk away, but you still get good returns as well.
Okay, very good answer. I should have given you the microphone again. Okay, so credit risk diversification. One of the key things that we have to do as investors in finance is that we can reduce our risk by diversifying our investments. Now, when you don't have a lot of money, that is just like virtually impossible to do. Say you're starting out in life and you got your first $1,000, you want to go investment. Your ability to diversify your $1,000 across a whole bunch of different types of investments is pretty limited. Maybe you can buy a bond, or maybe buy some shares in one company. That's about all you can do. Now, instead of doing that, instead of buying one set of shares in one company, if you invest in something like a broad-ranged investment fund, the investment fund itself may have stocks, it may have bonds, it may have money market securities, it may have real estate, it may have some commodities. And so by putting your $1,000 in this fund, they spread your money across a wide range of assets, and they give you diversification. And of course, for that they get paid, of course. But they provide you with a level of diversification that you as a small investor can't get otherwise. Last one, liquidity. What's that? Oh, Tim, go ahead.
Basically, by investing in a financial intermediary, instead of directly investing in certain types of investments, you might not be able to sell them very quickly and change it into cash. The financial intermediary can basically give you the cash as soon as you want it, and then they can kind of take that time constraint and can sell it a little bit.
Yeah. Okay. So the problem with many types of investment is that the ability to turn that investment into cash is quite limited. Like, for example, you think about the Riccarton Mall. If you owned it, and you want to sell it, it takes a long time to arrange a buyer. And, probably can't buy one because it's too big, but assuming you could, the liquidity is quite low in that type of market. But if you're an investor, say you invest in a real estate fund, they invest in assets that are very illiquid. They're hard to sell, and even when they do sell, it takes a long time. But they can provide you with the ability to both come in and leave pretty much as you want. So instead of having to wait, if you say, I want to pull my money out, oh, excuse me, I'm going to have to sell them all so I can pay you your $1,000 back, they can more or less pay you back straight away. And most of these funds will allow you to withdraw your money on the same day. You apply, and they'll take your money on the same day. And so they can take it in a very illiquid set of assets, and as an intermediary, they provide you with liquidity, so you can move your money in and out pretty much as you wish. And it gives you access to the type of markets that you probably wouldn't have access to. Okay, so before we move on, any questions on any of those before we roll over? Okay, everybody's at it. Okay, so there's a range of intermediaries, and basically the final third of the course is devoted to these types of institutions. Some of them you've probably come across already, like banks. If you come from Nelson or Southland, you might have come across a building society. If you own something like a car, you've probably already dealt with insurers. You may have come across finance companies, and superannuation, of course, if you have a KiwiSave, you've already come across these. So we'll talk more about these in the final one-third of the course. So now I'm going to look just briefly at the markets. There's 4 different ways you can actually start to think about the markets, and we'll go through them one by one. So the first way of thinking about a market is whether it's a primary market or a secondary market. So what's the difference between a primary market and a secondary market? Basically, how do these things function? What is their purpose? Anyone know what a primary market is or a secondary market? One or the other? Yep, go ahead.
So a primary market would be when the company would be initially issuing its stock. So when it issues its stock, people would buy that stock, and that would be primary. And then if those people go and trade that stock in the stock market, that's a secondary market.
Okay, so the difference between a primary and secondary is basically where does the money go? So in the example given is a company, say, may issue shares or bonds or something like that. And in the primary market, the money goes from the investor to the issuer. So for example, Auckland International Airport has talked for many years about building a second runway out there, And let's say they actually got around to doing it. They may raise funds through issuing shares. They may raise funds through issuing a bond. If you buy your shares or your bond at that point, the money goes from you to Auckland International Airport. They go spend it on the runway. So that is the primary market. Money goes from the investor to the issuer. In the secondary market, you're still trading those things, whether it's a bond or a share, but the money goes from one investor to the other. So the investor that is buying pays, and the investor that's selling gets the money, and does not involve the issuer at all. So in the secondary market, money goes from investor to investor, does not go between investor and issuer, but in the primary market, that's where it goes. So that's the basic difference between them. Now, there's one service that the secondary market provides which is quite important. This one here, this point here, about setting the prices is very important to investors. So that's one of the functions that the secondary market provides because, particularly say for many of these financial intermediaries, say like an investment fund, they often have a legal requirement to publish their asset value on a regular basis. Like if you're listed on New Zealand Stock Exchange and you're an investment fund, you have to publish your asset value on a daily basis. And so even though you're not buying and selling, you may not be buying and selling as a manager, you may just be holding on to your investments, you need to value investments on a regular basis. And so a secondary market, if one exists, you can just go out, look and see what the price is, and multiply how many shares you have, and you work out your value. As a private investor, having those prices there are very important to you because it lets you know what the value of your investment is. So the trading that goes on, often people think trading is kind of silly if they don't know much about finance. It's very important because that's what sets the price. And of course, what we use that price for is to determine the value. Now, it's often said, in this bottom bit here, the existence of secondary market makes primary markets more attractive to investors. So how would they do that? Why is that true? As we go through the course, I'm going to point out a number of places where there was a primary market, it was pretty inactive, they created a secondary market, and suddenly the primary market took off. So what is it about the existence of a secondary market that makes a primary market more attractive to an investor? You can resell. Okay, that's right. Can you elaborate as to what advantage to be able to resell does?
You could meet your different maturity needs or whatever.
Okay, so one of the things there is like
people have,
changing maturity. Is that a good point?
yeah, you could resell. That's what you wanted to do was change maturity.
Okay, so one is liquidity. And the other one you talked about is changing maturity. Now, when we think about the financial intermediaries, that's one way of solving those problems of changing the maturity and getting liquidity. The other way is, if you have a good secondary market there, you can actually do this yourself. You don't need financial intermediaries. Like, for example, in 2011, there was a 30-year bond issued by a company. And, of course, it doesn't mature until 2041, which is a rather long way off. Now, if there was no secondary market for that bond, most people would say, oh, my gosh, 30 years, I'll pass on that one, I'll get something else. But if there's going to be a secondary market and you can sell that bond at any point in those 30 years, then you can change your maturity yourself. So you say, well, I'm saving for, say I'm saving up to deposit on a house. I really only want it for 5 years. You could take a 30-year bond as long as there's a secondary market and you can go and sell it when you need it. And so you can actually transform your maturity yourself. You don't need a financial intermediary to do this. Also, in terms of turning into cash, it provides you liquidity. You don't need a financial intermediary to do this for you if you have a good secondary market there. And so, something like those long-term bonds, if there's a secondary market, that makes people much more willing to invest in the primary market because they know that whether they want to change their maturity, whether they want to get out, or maybe they have unexpected reasons for getting out, if that market's there, they know they can get out. And so that makes people much more willing to invest in the primary market than if there was no secondary market. And we'll come across several examples of where this actually happened. Any questions on that before we move on? Okay. Here's another way of looking at markets, about how trading goes ahead in these markets. So how does trading differ between an organized exchange and an over-the-counter market? There are different structures to trading. How would an organized exchange work? Anyone come across organized exchanges before, know how they work? Nobody knows. Oh, well, okay. Scroll over. Let's go. So the basic difference is that the organized exchange simply provides everything that is necessary for trading to take place. But the exchange itself does not do any trading. A good example is the New Zealand Stock Exchange. Its main building is up in Wellington. You can go and look at it if you want to. But basically, it's got all these computer systems in there that manage the order book. It matches the orders, makes sure that trades go ahead, ownerships get changed, money goes from one to the other. It handles all that stuff. But at no point in the trading does the New Zealand Stock Exchange own any of those shares. It simply provides the facilities for the trading to go ahead. And many stock exchanges and many other types of exchanges are exactly this type. Now, the other one, the thing that we call the over-the-counter, is kind of a funny one because it's just a name. Okay, but basically, we talked about brokers and dealers. These are the dealer markets. Another way, saying that instead of calling them a dealer market, we can call them over-the-counter market. And so that you're actually dealing directly with a dealer. And so if you think about the foreign exchange, if you want to make a transaction, you can basically go to any foreign exchange dealer. So basically any branch of a bank in New Zealand, you can walk into it and you can actually trade there with your foreign exchange if you want to. Whereas the exchange, stock exchange is in Wellington, in one building. And so the centralized location. With the dealer market, all you got to do is actually find the dealer. And for something like foreign exchange, there's lots and lots of them. They're all over the place. And so the dealers, they actually own the stuff that they're trading in. Think about the exchange, never owns what's traded there. A dealer market, over-the-counter market, you are dealing directly with the dealer who is either buying from you or selling to you. And as we go through the markets section, which is about the middle third of the course, we'll talk about whether this particular market, whether it's money market, bond market, and so on, is a dealer market or exchange market. Yes, go ahead.
I have a question for the New Zealand Stock Exchange. You said that because they don't own any stocks, but they provide facilities.
Yeah.
So does that mean that they are kind of stockbroker?
No, a stockbroker is the person who actually will do the placing of the orders on the exchange for you.
Yeah.
Okay, so they are not they're not considered to be a stockbroker. There's actually in New Zealand a stockbroker they have to be what we call a member of the exchange, but the brokers are quite separate from the exchange. Okay, the exchange.
How do they make money from the stock exchange?
They charge you a fee for every transaction.
So transaction fee.
Yes, there's a transaction fee, and of course we'd like that to be low. They'd like it to be high. Okay, and so there's a transaction fee. So every time you trade there, they will charge a fee for that transaction.
Is it fixed or just supposed to be like percentage?
It's not percentage. No, it is a per transaction fee. They were charging $25 last time I checked, but I would not swear that that's the right figure now. So basically, they also had a gradient with different sizes, so they went in steps. And so instead of like a broker would tend to charge you on a percentage commission, they charged you basically on the size, and they were fixed lumps as size. And so, like the smallest trade, they would charge you $25. Okay, and that's how they make their money. Okay, any other questions? Like, for example, the bond market in New Zealand, there's a bond market. That's an organized exchange as well. So if you want to trade your bond, say you have a bond from an issue in New Zealand, and you want to trade that, The market in New Zealand is an organized exchange, and so you would trade on an exchange market with your bond. In fact, it's actually run by the New Zealand Stock Exchange, but if you look at their website, it's actually just a separate part of their website. They have a separate order book, but it's just an exchange. So bonds are traded on exchanges in New Zealand. Okay, that okay?
Yes.
Okay. Any other questions? Okay, move on. Okay, another way of looking at markets is by the type of security or other financial instrument that gets traded there. Here are some examples. The derivatives are basically there for risk management, and we have a section on derivatives in the financial market section. Foreign exchange, there's a whole set of foreign exchange markets there. And then there's international markets where they're different from the foreign exchange in that the international markets are for trading things like money market securities and bonds internationally between countries, or, for example, within a country but not in its domestic currency. And we'll deal more with that in those two chapters there. One on money markets. Part of the money markets is the international money markets. And then that second one there, the bond markets, there's a section for the international bond trading. Another way of looking at them is this way, whether it's a money market or a capital market. And as we go through the markets, we'll talk about whether it's a money market or a capital market. What's the difference between them? What makes a money market different from a capital market? Length of time, can you expand on that?
Like money markets would be short-term and capital markets would be long-term investments.
Okay, so money markets are short-term investments, capital markets are long-term investments. Arbitrarily, we split it at a year. So if the investment is less than a year, it's considered to be a money market investment. If it's a year or more, then it's considered to be a capital market investment. And they have a different economic purpose, those two markets, or two types of markets, I should say. There's a bit about the short term. And the money markets exist basically to deal with the problem that many businesses have cash flow issues. Their cash flows do not come in smoothly and they do not go out smoothly. And so they can be temporarily short of cash or temporarily have excess of cash. And the money markets exist for them to handle that problem of either excess liquidity or not enough liquidity. And so they're very short term and they're low risk. Now, the money markets, there's a whole range of them, but they're all very similar. Now, before I go to the capital, I should say, so most of the money markets are dealer markets, okay? So they're not an exchange. They're dealer markets. You deal with people who own these securities. Now, there's just a list of some of them. This one here, the top one, this is a government one. Government one's up here. And all these are private sector. And that difference is actually quite important in these markets, whether it's a government security or whether it's a private security. And we'll come to these in more detail in the section on the money markets. Now, when we go to the capital markets, there's more than one. Arbitrarily, what we say, if it's a year or more, is a capital market investment. And what we're really doing in the capital market is we're trying to make long-term productive investments. You think about the money markets, they're trying to deal with lumpy cash flow issues. That's what money markets are for. Capital markets are about finding investments that are going to give you a good return by increasing productivity somehow. And whether it's building a new plant, manufacturing facilities, putting up buildings and so on, all those long-term things are capital market investments. And so the maturities tend to be quite long. If you're looking at the bond market, typically in the range of 5 to 30 years. New Zealand tends to be more shorter than that, although we do have at least one 30-year bond out there. And of course, if you go invest in common stock, that has no maturity date, so it's basically forever. And so if you think of the example of Auckland International Airport, if it decides to build a second runway, it's going to take a long time for it to make that runway. And even when they got that runway going and there's planes coming in, they're getting fees and there's more passengers, it's going to take quite a while to earn a good return on that major investment. And so if they're going to borrow money or raise money through the issue of shares, they want that money for a long time because it's going to take a long time for them to build it, and even when it's operational, a long time to make a good return and pay off either the debt or pay the dividends, as the case may be. So they tend to be very long term, 5 years and much, much longer out to stocks which are no maturity at all. One of the consequences of this is that when we look at the secondary markets, they tend to be a lot less liquid than the money markets. If you go and look at the New Zealand bond market, it's quite common to see bonds that do not trade on any one day. So if you want to sell, you might have to sit around for a few days before to sell. And it's just simply consequences of A, there's not as much of them, and B, they're long term. But this is quite important because, that you're taking a risk by taking out long-term securities. So the risk is higher in many, is more than one way of the risk is higher in the capital markets. And there's just a list of them: common preferred stock, corporate bonds, government bonds. Now mortgages are also considered to be a capital market instrument, but this particular textbook doesn't actually treat that as a separate market. So that wraps up the market section. And so now this is a one-off slide. There's a lot of international organizations because there's a lot of finance, trading, and investing going across countries, from one country to another. And the existence of some of these international organizations is, for regulation and watching over the international financial system. For the top one there, the Bank of International Settlements, that's like a central bank for the central banks of the world. Now, we're going to come to the central bank topic very soon. We'll look at the Reserve Bank of Australia. This is like a central bank for the world's central banks, and we'll figure out a bit more what that means as we go along. Some of those other ones, World Bank, International Monetary Fund, Asian Development Bank, and things like that, you may have come across them from time to time, and they operate across multiple countries because finance these days runs across many, many countries, and money is moved around all the time. Okay, financial risks. Let me see. So we're going to ask the question, what are the major risks faced by the financial institutions, and why is it important that they be carefully managed? So here's the list of 8. And we're going to ask, what are these things, and why is it important for a financial institution to manage this type of risk? So top one, credit risk or default risk. That's two names for the same thing. What is it? Why is it important for a financial institution to manage its exposure to that type of risk? Go ahead.
The risk that someone you loan money to will default on the loan and not pay you back.
Okay, so the basic deal is you make a loan. This risk is that they may not pay you back. That may be anything from paying you late to stop paying you at all. And it's obvious if that happens, you lose money. So if you face that type of risk, you have to take steps to try to manage it. What about interest rate risk? What's that?
Interest rates will change. So if you have an interest rate locked in on a mortgage or something, and then the market rate changes, you're going to be better or worse off, depending on which way the rate goes in relation to the fixed rate.
Okay, so the key point there is that many securities have a fixed interest rate to them. Like, for example, if you have a bond, typically the interest payment on that bond is fixed. But the interest rate in the market goes up and down. And so what that does, if the interest rate changes and your interest rate's fixed, that can work to your favor, can put the price of your bond up. But if it works against you, it can put your price of the bond down. There's actually two pieces to that interest rate risk, what we call the price risk and the reinvestment risk. And we'll deal with this fairly soon. But anyway, it's a risk. It's a genuine risk. You may lose money over it. And so if you as a financial institution have that risk, or an individual, you must take steps to manage it. What's the liquidity risk? Oh, sorry, did you have a question?
For the second one, does it include the OCR change?
Oh, definitely part of it. Yeah, part of, yeah. If they move the OCR,
Yeah.
that's
Systematic risk is included in the interest rate risk as well. Is that?
Yeah, basically any movement in interest rates, and if the Reserve Bank moves its cash rate,
Yeah.
That's definitely going to affect you. That will be part of your interest rate risk that you have to manage. Okay, any other questions? Okay. What about liquidity risk? What's that?
Risk that you won't be able to get your investment back into cash when you want it, or there might be additional costs to getting your investment back into cash when you need it.
Okay, did you have a second point?
Yeah, and basically the thing that's bad with that is that you won't actually be able to if you have debts coming up. You won't be able to pay those debts and incur further penalties.
Okay, so there's two types of risk there. One is like if you want to sell, say you have a security and you want to sell it, a liquidity risk would be that you can't sell it when you want, or the other thing that could happen is you may not get fair value for it. And both of those are a type of liquidity risk. Now, the second type of liquidity risk is that if you as a business have a bunch of bills to pay and you don't have the cash on hand, that is a type of liquidity risk. Now, typically in that situation, you can, if you're a business, you can borrow somehow to cover your liquidity problem, but it's a risk that you have to manage. Now, this liquidity risk is far, far, far more serious than most people ever realize. When I get to the section on the derivatives, I'll show you some of the biggest losses in history. One of them was long-term capital management, went belly up with tremendous losses, close to $2 billion. And they got caught with this one, liquidity risk. Now, they were not dumb boys, okay? They had two guys with Nobel Prizes in economics, and they had an army of people with PhDs, and they got caught with liquidity risk. And they went, that's just, putting it politely, of course. Okay, so it's a serious risk, and if you face it, you've got to keep it under control. What's foreign exchange risk? Go ahead.
Fluctuation of the foreign currency exchange rate.
And how would that actually, it's right, the fluctuation in exchange rate is the risk, so how is it going to affect someone, say a business?
Similar to this interest rate, that if you have a company like in multiple countries, they have like foreign exchange rate difference, and if it's that going down, and you're going to lose money.
Okay, so like if you're a company and you've got operations in another country and you say you made some profits over there and you want to bring them home,
Yeah.
if your exchange rate moves unfavorably, those profits are no longer worth as much as they used to. Yeah. So that's what foreign exchange risk is. Of course, it can actually work in your favor. If it goes in the right way, it can actually be worth more than you thought. But both of them are risk. And you have to manage it. What's political risk? Go ahead.
It's to do with basically politics. So, for example, a country implements new regulations or something, and that might change the financial institutions sort of spot.
Yeah, that's right. That's basically right. Anything that politicians do, whether it's legislation or changes in regulations, that affect the value of your investment. And it can range from fairly simple things like sometimes they'll put capital controls on. You can't move money as freely as you can. And some places, some of the sort of third world companies, they may even nationalize your investment and then you've lost it. So it's basically anything that forms, comes out of the political arena, any change there, that changes the value of your investment. If you watch the movie, I think it's Arbitrage, it's kind of hard to tell in that movie what's going on with the problem because this guy running a hedge fund and he wants to sell it, and it's kind of really hard to figure out what's going on as to why he has the problem. And it's only mentioned once in the movie, but it is a political risk. He moved money into a country, they put capital controls on, he couldn't get it back out, and he was in deep trouble. Hedge fund manager didn't manage his risk properly. In that movie, it was a political risk. What's reputational risk? Go ahead.
Let's say an ethical investment that's borderline in terms of your ethics, and so you'll end up actually receiving a bad reputation for it. And that will also, basically the result is that least people want to deal with you.
Yeah. So basically, often reputational risk is self-inflicted, but basically, it is something you've done something to make a bad name for yourself, and then of course you got a bad name. People don't want to deal with you anymore. Okay, so nearly out of time. Environmental risk is kind of obvious what that is. Operational risk, sometimes you get rogue traders who will actually lose you lots of money. It's just part of your operations, but they go off and take, lose money for you. Okay, so you do have to manage this carefully, and as we go through the course, we'll talk about how this is managed as we go on. But there's various ways of dealing with each of these risks in turn. And there's a final bit, not all of the chapters relevant, and in each section there'll be a slide like this at the end to basically give you some guidance about which parts of the chapter is most relevant. So if you want to ask any questions, be around for a while. Otherwise, we'll start a new topic on Friday.
Just wondering for this reputational risk. So how did that happen? Can you give me an example?
Reputational risk, like for example,
Yeah.
If you get say you get a reputation for like giving bad financial advice. Say you're a financial advisor and you get a reputation for giving bad financial advice. People will go to another financial advisor, and that's your business. You lose business because you've made a bad name for yourself.
So does that, from your thing, is it company's risk? Is it part of the company's risk?
Yeah, like for example, investment banks have faced this problem, because they're bringing new securities to markets on behalf of their clients all the time.
Yeah.
If they do a bad job, like in the sense that they misprice the securities, they can develop a bad reputation of not fairly pricing securities, and so there's more than one investment bank out there, and so when someone wants to bring securities to market, it's like, they're not very good. So I will go over here. And there's almost always an alternative. And if you make a bad reputation for yourself, your business will go somewhere else.
Oh, okay. Oh, I see. Thank you.
Could you explain what is the over-the-counter market?
Well, it's just the name, but it's the name that we give to the markets where you're dealing with a dealer.
Oh, okay.
Okay. It comes from way back in the way back in the days when you used to have to go somewhere. Like if you want to trade foreign exchange today, you can do it on your credit card. You can do it online on your credit card. But in the old days, you would have to actually go to a bank and take some notes and coin in and actually trade it, and it'd be a counter. And that's where the name comes from. But it's basically, when we talk about over-the-counter markets, it's a dealer market.
Okay. Okay, I see. The difference between the money markets and the capital markets, the biggest difference is one of them is short-term and another one is long-term.
Yeah, and arbitrarily we set that difference at a year. So anything up to 1 year is considered a money market security, and they're all debt securities. Now, when we go to capital market, that's year and over, and there are debt securities which we consider to be capital market instruments, and there are equity securities, and there are capital market instruments, and because they mature in more than a year. All the securities that trade in the money markets are debt securities. Okay, but that 1 year line is kind of an arbitrary line, but that's where we make the division. If it matures, the original maturity is less than a year less, then that's a money market. If it's longer than that, it's considered a capital market. And often, like when you think about why are they borrowing if it's debt, the reason they're borrowing short term is very different to borrowing long term.
Okay, thank you.
Cheers. How you doing?
All right.
Good. I'm Jordan, by the way.